Welcome back to The Explainer. I'm absolutely thrilled you're here today because we're unpacking something pretty fascinating. We hear about trade deficits, exchange rates, and foreign reserves in the news literally all the time. But how do entire nations actually manage their global transactions? How do they keep track of all that wealth and figure out the true value of their currency? Well, today, we're going to break down exactly how these massive gears turn together to keep a country's economy running smoothly. Let's get right into it. Just think about your own personal finances for a second. You've got income coming in, expenses going out, maybe a loan or two, right? And you hopefully keep track of the whole shebang so you don't go broke. Now, have you ever wondered how a whole country balances its checkbook? Like, how does a nation actually track the billions of dollars flowing in and out across its borders every single day? It sounds like a giant puzzle, but we're going to demystify this whole complex macroeconomics thing today. Okay, let's dive into this. Here is our roadmap for today. We're looking at the global checkbook, trade versus payments, the exchange rate enigma, supply, demand, and rupees, India's trade playbook, and finally, fueling trade with the EXIM Bank. Moving right into Section 1, the global checkbook, tracking international transactions. So just like you or I need to track our spending, international trade requires a super meticulous record-keeping system. Every flow of people, material, and capital needs to be accounted for. And that brings us to a completely foundational concept, the balance of payments, or BOP. This is a systematic record of all international economic transactions, both visible and invisible, of a country during a given period, usually a year. It's not just some boring accounting spreadsheet. It's a vital health report. It actually reveals a country's economic dependence on the rest of the world and its capability to use external resources to grow. Which brings us to Section 2, trade versus payments, looking at the whole ledger. Now, people often use these terms interchangeably, kind of confusing a nation's trade balance with its overall balance of payments, but they are very different things. The balance of trade, or BOT, only deals with visible items. We're talking strictly the exports and imports of physical merchandise. If a country exports more physical goods than it imports, boom, it has a surplus in BOT. But the balance of payments, the BOP, that's the much larger pie. It includes that balance of trade plus all the invisibles. What are invisibles? Well, they're services, things like banking, insurance, civil aviation, tourism, and investment income. So BOT is really just one piece of this massive comprehensive BOP ledger. To understand the BOP even better, we have to split it into two main accounts. Think of this like your household budget again. On the one side, we have the current account. This is basically your daily income and expenses. It tracks the daily flow of goods, services, and travel. On the other side, we've got the capital account. This is a bit more like taking out a mortgage or investing in a new property. It tracks borrowings, lending, and the repayment of old debts to the rest of the world. So how do these two accounts actually interact? Well, there's a fascinating rule here. The current and capital accounts will always move in opposite directions. If a country has a deficit on its current account, meaning, it's spending way more foreign exchange than it's earning, it has to cover that shortfall somehow. And how does it do that? By borrowing from the rest of the world. This borrowing creates a surplus on the capital account to match the deficit on the current account. But here is a absolutely critical warning from our source. Financing a current deficit with a capital surplus is essentially just kicking the can down the road. It postpones liabilities to the future, meaning the external debt burden is just going to keep increasing. Okay, moving on to Section 3, the exchange rate enigma. What is the money worth? Because keeping the ledger balanced is literally only half the battle. The real trick is figuring out what that money is actually worth across borders. We handle this through the rate of exchange. This is simply the price of a unit of one currency in terms of another. For example, if an Indian importer needs to send money to Great Britain, the bank calculates the price in the home currency, say paying 54.21 Indian rupees for exactly 1 British sterling. The rate of exchange is basically just a price tag on money itself. Now, you'll want to notice the distinction between the current rate and the par of exchange. Just like the price of everyday commodities, the current rate of a currency fluctuates from day to day, or even hour to hour, based on short-term market forces. But these aren't just totally random, accidental jumps. They orbit around a definable norm, which we call the par of exchange, or the normal rate. This parity is influenced by deeper monetary systems, and sometimes the par value is even fixed by authorities to keep it within certain safe limits. That brings us to Section 4, supply, demand, and rupees. The market forces at play. If the current rate fluctuates daily, we definitely need to know exactly why. In a free foreign exchange market, the rate is determined by the oldest rule in the economics playbook: supply and demand. To make this abstract concept instantly relatable, let's use a brilliant analogy from the source, the milk seller. Imagine a festival day. Suddenly, there is an unusually high demand for milk in the market. The sellers look at their inventory and realize, no way can our current stocks meet this massive demand at the usual price. So, what happens next? They raise the price of the milk to balance out or equate the demand with their supply. And the crucial point here is that this exact same logic applies to foreign currency. If there's a sudden high demand for US dollars and the supply hasn't changed, banks will equate demand and supply by raising the exchange value of the dollar in terms of rupees. Conversely, if banks have excess dollar supply, so low demand, they lower the dollar's price. What actually drives this demand for foreign currency? Well, things like importing goods, utilizing foreign shipping or insurance, or residents traveling abroad as tourists or paying for higher education overseas. All of these activities require foreign currency, which drives up its demand and therefore its price. All right, Section 5, India's Trade Playbook, Managing the Ledger. Let's shift our focus to India's specific strategy for navigating this giant system. A totally pivotal moment in India's economic history actually happened on March 1st, 1993. From this exact date, the exchange rate of the Indian rupee was left free to be determined by the market forces of demand and supply we were just talking about. But letting the market decide absolutely does not mean the government or the central authorities just sit back, relax, and watch the show. The Reserve Bank of India, or RBI, actively retains the right to intervene in the foreign exchange market to assure stability. Consider this fascinating mechanism. What happens if a huge inflow of dollars suddenly hits the Indian market? Well, the dollar supply is high, so the value of the rupee goes up, or appreciates. Now, you might think a strong rupee is great, right? But actually, an appreciated rupee makes Indian goods much more expensive for foreign buyers, which can severely hurt India's exports. So, to prevent this, the RBI actually steps in and physically purchases dollars in the market. By buying dollars, they artificially increase the demand for them, which stabilizes the exchange rate and protects the competitiveness of Indian exports. It's a really clever balancing act. Let's wrap up with Section 6, Fueling Trade. EXIM Bank, the strategy in action. Let's look at the specific tools and policies India uses to boost its position, particularly through its export-import policy and the EXIM Bank. To generate those massive current account surpluses we want, India relies heavily on the EXIM Bank. Now, the EXIM Bank doesn't just sit on cash. Its core role is to provide absolutely vital financial assistance to exporters and importers. It basically acts as the principal financial institution coordinating India's global trade operations, making sure domestic businesses have the capital and support they need to really compete internationally. Because the ultimate takeaway here is this: avoiding the trap of rising external debt means a country must aggressively expand its exports. The EXIM Bank's initiatives, like funding overseas ventures and supporting export-oriented industries, are the practical, boots-on-the-ground policies acting as the only permanent solution to the balance of payments problem. A rapid expansion in exports is the true key to economic self-reliance. Which leaves us with this final, somewhat provocative thought. If rapid export expansion truly is the only permanent solution to preventing massive external debt and balancing the national checkbook, what specific steps must a country take today to force the world to demand more of its goods? It's a massive question of innovation, quality, and aggressive global strategy. Thank you so much for joining me on this explainer. I really hope this helped illuminate the massive machinery behind global trade. Keep learning, keep questioning, and we'll see you next time.